world is experiencing unprecedented times as it relates to inflation. And inflation, we have seen how inflation is eating away at the profit of local companies. That is, companies listed on the Jamaica Stock Exchange. We have seen the impact of inflation on most of those companies' operation. So as a result of that, we are dedicating a series of videos to looking at inflation and how the central banks and the world is navigating inflation. So this article that I'm about to analyze or read through is one in an overseas news media about inflation in the United States. If you're following our channel, you'd have noticed that we looked at the last article that we read through or analyzed was about inflation in Europe. And we also said that Europe, the European Central Bank, is the most aggressive central bank currently because it is really fighting inflation in that part of the world. They have recently increased interest rate to about 3/4 of a percentage point, which is very aggressive, and it is the most aggressive increase in rates in that part of the world since over the last 20 years. All right, so the last time the European Central Bank or the ECB was this aggressive about taming inflation was about in 1999. That's over 20 years ago. We see how inflation in those parts of the world is impacting the local market and the local companies or companies listed on the Jamaica Stock Exchange. So what we want to do, we want to take it close at home. All right, what is happening in the United States? How has the Fed been treating with inflation? All right, so we want to look at that now. There is an article that I saw in an overseas paper that deals with central banks, all right, or the Fed, and it is written by one Christopher Rugaba, all right, and it is titled, "Driven by Consumers, U.S. Inflation Grows More Persistent." All right, so just by looking at this title, it is really saying that the Fed has not tamed inflation as yet. All right, so in the last quarter, we see where there was a little pullback in inflation. All right, however, this article is saying that inflation persists. All right, so we want to see what this article is saying about inflation in the United States. And as I know, them normally say anything happening in the United States. If US sneeze, then we catch flu, whatever. All right, so anything happening in the United States will have an impact on the Jamaican economy. And it is also said that most of the inflation that we're experiencing on the local market or in the local economy is being imported. All right, that is to say that it is the inflation that is happening in the United States that is affecting us. So when price increase in the United States, it is likely that prices will increase in the local market, and we'll see where BOJ is trying its best to keep the exchange rate stable so as not to pass through those prices to the local economy. All right, so let's just get into the article. But before we do that, may I ask you to just subscribe to the channel and like the video, because this will help with growing the channel. All right, getting at the article. US inflation is showing signs of entering a more stubborn phase that will likely require drastic action by the Federal Reserve, a shift that has panicked financial markets and heightens the risk of a recession. All right, so here it is that, again, we are reiterating that inflation, we are not out of the woods. All right, as it relates to inflation, the world is still experiencing a phase of worsening inflation, and central banks are trying their best to tame this inflation. But the thing is, this inflation is a bit different from what they are used to, is a bit untraditional. All right. And I spoke to the fact that this inflation is different from what the world has become used to. We'll go ahead and play that clip right now, and we will get back to the article in a few.
7%, madam, right on the edge. And that's the reason why I love NCB, because they're aggressive. But you see, now that the storm come, them kind of, wow, weather the storm, them start, you know what I mean?
Storm coming. Speaking of storm, so were you expecting a recession?
I mean, the US market is in a mild recession.
Yeah, US market.
It's in a recession already, but it's a recession kind of different from the traditional recession where we know it. Because we always know, all right, so the economy operates in a, whatever they call it, a peak and a trough.
Yeah.
Yeah, so it go up there, so then it come back down. Normally, when it go up on top, you normally have like your labor. It's normally labor cost that triggers inflation, you know. So when you're expanding, you start employ everybody you can expand. I mean, you can employ. And the more people you employ, the more wages have to pay out. And then the people who will get the wages now, them turn around and buy the goods them. So demand increase and that push up inflation. See? And then the central bank could have come now and kind of sort out that. But what we see happening is that inflation has increased. Central banks start increasing rate to sort out the inflation fire over there. So. Yeah. But you see the US market continues to employ more people. In July, them saw 500, almost 28,000 people employed.
Why is that so though?
Yeah?
Why do you think that happened?
No, what may I say, the market don't really reach a peak yet. So it still have room for expand, even though GDP, I think.
Them start cut the job then.
Yeah.
Yeah, a couple companies start cut, but overall net.
That's because of the monetary based expansion by the central bank cause them to have a lot of cash they could hire. But
yeah. So what I'm saying now with the inflation is that we think, even though you see inflation will calm down away, I think the inflation, you will have some pressure from the wages.
As I said before, this inflation is untraditional. It is different from what we have become used to. And as I said in the article, as I said in the clip, we have used to wage inflation, wages causing inflation, and that is after the economy has reached a peak. All right, and then wages build up, and then that caused inflation, and then it put the economy in a spiral after the central banks try to calm that inflation by tightening monetary policy, and that will see the cost of goods, the cost of loans, the cost of mortgages, so the cost of money increasing, all right? And as a result of that, it will tend to put a downward pressure on inflation. However, what we're seeing with this inflation is that it is more widespread. It is caused not by labor increase, all right? And we will get to how labor increase is fueling the inflation, as we said in the clip that we were suspecting a sustained inflation moving forward, because we have not seen where the labor market has peaked out, because the labor market is still strong. All right, so the inflation is more widespread, and as you know, inflation is an average increase in goods and services. So what that means is that different economy or different segment of the economy can be experiencing different rise or different rate of rise in prices. All right, so you might have goods increasing rapidly in price, but services, all right, not increasing as rapidly. But so you might have one segment of the economy or one industry where prices are increasing, whereas other industry, you might see a fall off in price, but the overall prices in the economy is increasing, and that's what inflation is. However, we are seeing in this inflation phenomena, all economy all industry within the economy, all aspect of the economy is facing increased prices. All right. So in the service industry, you're facing increased prices. In the manufacturing, in the goods production segment of the economy, it is facing increased pricing. And as a result, the inflation is more widespread than normal. So because of this, it is harder for the central banks to really control inflation. All right. So this inflation is different from what we have become used to, what the central banks are used to, and it is much harder to control. All right, so as I said, this inflation is being fueled by a strong job market. All right, so the job market is still strong, and as a result, inflation is persisting, and that is what I was trying to explain in the clip. All right, so even though in the quarter before now there was a small pullback in the inflation numbers, we were suspecting that as the US economy continues to employ more people at higher wages, then that income that people are getting, or that higher income, will go into tracing goods and services and increase demand and cause the inflation to continue. And that is what this article is about. All right, so businesses continue to employ people and boost paycheck. So they're employing people at higher rate, higher salary, higher wages. All right, and that wage costs has caused inflation to persist. So the article went on to say that on Tuesday, the government said inflation ticked up 0.1% from July to August and 8.3% from a year ago, which was down from June's four-decade high of 9.1%. All right. So there was a small uptick in inflation. However, inflation year over year was down, was different. It came down a bit, a shade from the 9.1%, and is now sitting at 8.3%. However, if what the inflation that has pulled back is what they call headline inflation. All right. So headline inflation is the inflation that involves both the cost of the cost of food and the cost of oil. All right. So food and oil are very volatile and they move up and down like daily. So if you want to get a better understanding of how inflation is impacting the consumer demand, is impacting the cost of living, all right, what you want to look at is core inflation and not just headline inflation. So what they did in order to calculate the core inflation is to strip the inflation numbers of the oil and the food, all right, which is what you call core inflation. So it is headline inflation minus the increase in food and the increase in oil prices. All right, so you get a more stable reading of the inflation numbers. All right, so when you look at the core inflation and not the headline inflation, what we saw happening is that from July to August, inflation was up not by 0.1% now, but 0.6%. That's 6 times what headline inflation is reporting. And that is versus a 0.3% in the previous month. All right, so core inflation uptick for the July to August period has doubled. So that is an increase of 0.6%. And the previous quarter saw an increase of 0.3%. So inflation has doubled, all right, for the July to the August period. So the article went on to say that one of the most remarkable thing is how broad-based the price gains are, said an economist. The underlying trend in inflation certainly has not shown any progress towards moderating so far. And that should be a worry to the Fed because the price gains have become increasingly demand-driven and therefore likely to be more persistent. All right, so the article is basically saying that when the inflation is demand-driven, when it is a demand-driven inflation and not a supply pull inflation, all right, so what they call it, a demand push inflation. All right, so when the inflation is demand-driven, it's driven by demand and not by supply, then it is more persistent and it is harder for the central bank to get a hold of that type of inflation. All right, so what we know about demand now, the last video that we did when we look at the European Central Bank, ECB, all right, and how they were moving aggressively to quell inflation, what Christine Lagarde stated was that they were moving that aggressive so as to cut demand from both from government, from businesses, and from consumer. All right, so from consumers. So what we know is that consumers represents the larger portion of any economic growth. Now, in the United States, consumer represents some 70% of the economic growth. So that's the largest portion of economic growth. All right, so here it is that they're saying inflation is consumer driven. All right, it is demand driven. So it is the demand that is coming from consumer, that larger portion of demand that is driving inflation. And that is where the problem is, because when it is consumer driven, it is harder for the Federal Reserve to get control of the inflation and choke demand from the economy. All right. So the Fed will have to be more aggressive. All right. And a lot of economists are saying that they're expecting the Fed to be more aggressive, to move more aggressively to tame inflation, simply because they have now realized that this inflation is no joke. And it is coming from that section of the economy that is far more harder to control. All right, that is far a greater portion of economic growth. All right, and that is the consumer section. All right, so it is the consumers that are pushing inflation, that are driving inflation, and as a result of this, it is really hard for the central bank to get a hold of inflation, and that is the reason why inflation is persisting this long. All right, so the article went down into some reasons as to why demand is so strong. All right, so what it is really saying is that coming from the heels of the lockdown and the pandemic, all right, where persons has postponed vacation, entertainment, and restaurants for over 2 years. All right, now because of that, consumers find themselves with a lot of savings. All right, so it is that savings now that is flooding the market, that is increasing demand, and people are going back into the economy to spend, going back on vacation, going back for the entertainment that they so missed out on. All right, so that is what is keeping that drive, that is what is keeping demand high. All right, the high savings that people were able to accumulate, that consumers accumulate after over 2 years of non-spending. However, when you couple that with pandemic relief, remember the government was giving people pandemic relief check in the pandemic. All right, so most of those pandemic relief check went straight into the bank as savings, went straight into people's pockets as savings. So it is those money that people are spending currently. All right, so what you find happening now is that there's a lot of pent-up demand, and that is what we're seeing, and that is what is keeping inflation high and persistent. The article went on to read that when inflation is driven mainly by demand, it can require more drastic action from the Fed than when it's driven mainly by supply shocks, such as an oil supply disruption, which can often resolve on their own. All right. So that really explains itself. So it is really telling us that demand inflation is of more threat to the economy than supply shocks. All right, so as the article is saying, the Fed might need to get more aggressive, all right, because of the nature of this inflation that we're experiencing. And they're expecting, it is a lot of economists are expecting that inflation will persist and continue to persist for some time. So as a result of that, the Fed will have to get more aggressive in order to tame this inflation monster that we're experiencing. All right, so some economists believe that the Fed will have to raise rate to 4.5%, all right, by early next year. All right, so over the couple of months, the Fed will have to raise rate to over 4.5%. Now, first, they were expecting that early next year raise should be about 4%. All right, so currently they have increased that. All right, they are expecting that to increase, and a lot of economists are saying that a 4% increase in rate over the next couple of months leading up to 2023, will not be able to solve the inflation problem. Currently, rate is some 2.25% or 2.5%. So rate is normally between those two figures. All right. So raising rate above 4.5%, that means the Fed will have to raise rates some 200 basis points at least. All right. So most economists are expecting the Fed to become more aggressive, and they're expecting the Fed to raise rates to at least 200 basis points to over 4.5%. So they're expecting the Fed to become more aggressive at what they're doing. All right. And as the Fed looks to raise rate next, some economists are expecting a 0.5%, that's a half of a percentage rise, which is what the Fed has been doing. All right, but some economists believe that the Fed might need to raise rate by 1%. All right, so that is some very aggressive move that they're expecting. All right, so what increase in rate mean? All right, so as we spoke about the inflation, the nature of the inflation, and the fact that inflation is being driven by demand from consumers, what the Fed or central banks around the world are trying to do is to choke off demand. All right, so what they want to do is to increase rate and make demand, the cost of money, more expensive. All right, and that they're expecting to choke off demand in order to quell the inflation monster. So an increase in rate will mean higher mortgages, all right, higher auto loans and higher business loans, all right. However, the economists, even though rate has been increasing for some time now, as I said, rate is coming from almost 0% to now 2.5%, all right. The economists are not seeing where this is having an impact on the economy. All right, so it is not starting to sink in as yet. All right, so it is demand destruction that leads to us talking about demand destruction. And what is demand destruction? Demand destruction, as most economists believe, is the natural dying of inflation. All right, so the Fed is not able to kill inflation, even though they have been raising rates. All right, inflation persists. People continues to demand goods and services, and this is due to the fact that consumers have a lot of savings in their savings account, and that is the money that they're using to purchase goods and services. All right. So the Federal Reserve moving up in its rate is not starting to impact demand as yet, because simply because people are not people have money already, and they do not need to enter into the market to borrow money. So most of the money that is going after goods and services is pent up money. All right. Now, economists are expecting the demand destruction effect phenomena to start taking effect. All right. And demand destruction simply means as prices get higher, consumers will naturally pull back on their demand, on their purchasing of goods and services, on their spending. All right. So that is like a natural cure for inflation. All right. So that is demand destruction, has nothing to do with the Fed. It is just left to the economy. The prices are increasing. And as price increase, people believe that goods and services are not worth what they are being sold for. And as a result, they will pull back on their purchases of goods and service. However, we're seeing where that has not starting to take effect as yet in the American market, nor has the central bank's policy, rate policy strategy, monetary policy strategy has not started to take effect on consumer behavior. All right, so what they're seeing is that there was a little pullback in American drivers. All right, so people are driving less due to the higher price of gas. However, outside of the gasoline sector, there is no pulling back of demand. So the restaurant jumped some 9% in August, 8% year over year, the restaurant price, or the price of eating out. However, people are still eating out. All right. And I guess this has to do with some amount of psychology as against economy. All right. So people has been locked up for over 2 years, and that locked up demand, that pent up demand, they're just expressing that. All right, so inflation spread into service sector, and the article went on to state that when you look in the service sector, you're seeing where there have been inflation, there have been rising prices in the service sector, in the hospitals, wages in the hospital has increased, and that is the proof that wages are getting higher. All right, and this is what is causing inflation to persist. All right, as the Feds try to quell the inflation monster. So wages and salaries are up 6.7% in August, and they're saying that this is the biggest increase in wages and salary for over 40 years. All right, so that is what the article is saying. It has expressed the concern that inflation in America persists, all right, and is persisting. And the Federal Reserve monetary policy has not started to take any effect, has not started to have any effect on the inflation that the country is experiencing, all right? And inflation is really driven. It is the consistency of inflation, the persistency of inflation is driven by the increased salary, all right, and the increased wages that has been paid out by many companies, all right. So as consumers get these increased wages, they are looking to buy more goods and services, and as a result of that, inflation continues. Now, as we spoke about demand destruction, that is where people start pulling back because prices are getting too high. People start pulling back on their purchases. We have not reached that point, all right? And we're seeing where the Federal Reserve strategy, monetary tightening, has not started to take effect on consumer demand. All right, so that's something that we will keep a tap of. We will look at the job numbers to see whether or not US companies continues to employ people, or are they cutting back on their employment. All right, so what does all of this mean? All right, so what it really means is that Jamaica and Jamaican companies purchase a lot of raw material overseas. And as a result of this, inflation in these overseas markets is impacting the results that companies listed on the Jamaica Stock Exchange are able to record. All right, so we see where lumber result was impacted by this inflation. JBG, all right, Jamaica Boilers result was impacted by the inflation, and that continues. All right, so as I know, I hope you enjoyed this article, and we will continue to read and analyze these articles for you. All right, so I beg you, just share the content, like the video. Remember to like the video and subscribe to the channel if it is that you have not subscribed to the channel as yet. And talk to you in the next one.